When you walk into a bank or open your banking app, it feels like a place where money simply sits behind a digital vault. We think of banks as storage lockers for our cash. But if they were just lockers, they wouldn't be multi-billion-dollar corporations. Banks are, at their core, massive middlemen. They don't just store value, they move it, manipulate it, and charge for the privilege of doing so. Today, we are stripping away the complexity to explain the exact mechanics of how a bank turns your deposits into their profits. To understand the banking business model, you have to understand the spread. This is the most traditional way a bank makes money, and it's surprisingly simple. Think of a bank as a marketplace for money. On one side, you have savers, people like you who deposit money into a savings account. To encourage you to keep your money there, the bank pays you interest. Let's say they pay you 1% per year. On the other side of the marketplace, you have borrowers, people who need money to buy a house, start a business, or get a car. The bank lends them the money you deposited, but they don't charge 1%. They might charge 7% for a mortgage or 15% for a personal loan. The difference between the 7% they collect from the borrower and the 1% they pay to you is the spread. This is also known as the net interest margin. That 6% difference covers the bank's operating costs, like staff, buildings, and technology, and whatever is left over is pure profit. Now, you might wonder, if the bank lends out my money, what happens if I want to withdraw it tomorrow? This brings us to a concept called fractional reserve banking. In a perfectly intuitive world, if you deposit $1,000, the bank would keep that $1,000 in the vault. But banks realized centuries ago that all their customers never come to withdraw all their money at the exact same time. Usually, only a small fraction of customers need cash on any given day. Because of this, regulators allow banks to keep only a fraction of your deposit, often around 10%, and lend out the other 90%. If you deposit $1,000, the bank keeps $100 in reserve and lends $900 to someone else. Here's where it gets interesting. That $900 loan usually ends up being deposited into another bank account by the person who received it. That second bank then keeps 10%, $90, and lends out the rest, $810. This cycle continues, effectively creating new money in the digital economy. This system allows banks to maximize the amount of interest-bearing loans they have active at any one time, far exceeding the physical cash they actually hold in their vaults. While interest is the main course, banks have spent the last few decades building a massive buffet of non-interest income. These are the fees we see on our statements that often feel like minor annoyances, but add up to billions in revenue. First, there are service fees. This includes monthly maintenance fees for checking accounts, overdraft fees when you spend more than you have, and ATM fees when you use a machine outside their network. For a bank with millions of customers, a $10 monthly fee becomes a massive, predictable revenue stream that doesn't depend on interest rates. Second, there are interchange fees. Every time you swipe your debit or credit card at a grocery store or a gas station, the merchant has to pay a small percentage, usually between 1% and 3%, to process that transaction. A portion of that fee goes directly to your bank. They are essentially taking a tiny tax on almost every transaction you make in your daily life. Large, universal banks go even further. They don't just act as your local lender. They act as investment houses. One major revenue source is wealth management. If you have a significant amount of money, the bank will offer to manage your investments for you. They charge an asset under management, or AUM fee, typically around 1% of your total portfolio every year. Whether your stocks go up or down, the bank gets paid for the management service. Then, there is investment banking. When a massive company like Apple or Tesla wants to issue new stock or buy another company, they hire a bank to handle the paperwork and the legalities. For these advisory services, Banks charge massive success fees that can reach tens of millions of dollars for a single deal. They also engage in trading revenue. Banks have floors full of professional traders who buy and sell currencies, bonds, and commodities. They make money on the bid-ask spread, the tiny difference between the price they buy an asset for and the price they sell it to a client for. In a volatile market, this can be one of the bank's most profitable divisions. It's important to note that making money in banking isn't just about collecting checks, it's about managing risk. Every time a bank issues a loan, they are taking a gamble that the borrower will pay them back. When a borrower defaults, meaning they stop paying, the bank loses money. If you found this breakdown helpful and want to see more content that pulls back the curtain on the financial world, make sure to hit the subscribe